Hey, what's going on, everybody? I wanted to put together a quick little class, if you will, to show how I personally obtain my goal of making at least 2 to 3% a week on my total account balance. And I do this by placing high probability 2 to 1 reward to risk trades using the TTM Squeeze Pro with credit spreads. And if you didn't know, TTM means trade the market, so trades with Trade the Market Squeeze Pro. That was created by John Carter over at Simpler Trading. And this indicator has really changed the way I trade. My consistency has significantly improved since learning about this indicator. I wish I would have learned about it sooner when I started trading. I didn't learn about it until maybe 3 years after I've been trading. Anyways, something definitely worth everyone learning about. All right, so first you need to change your mindset on what risk reward is. So how I view this setup is it's a better use of capital for swing trading by using options versus stocks. And what do I mean by that? I can explain it in this example. So in this example, you have a $100,000 account. Say there's a stock that is $50 a share, and you want a 1,000 share position. You're going to need $50,000 for the position, which is 50% of your account. And at a $1 stop and a $2 target, you have a max risk of 50,000. Say news comes out or something, and it drops down to zero. Sure, you lost $50,000. Likely, not really, but there is gap risk where you still lose more than your $1 stop. But at your stop level, you have a $1 stop, so it'll be a $1,000 loss and a $2 target, which is a $2,000 win or profit. Now, so instead of using so much of that money, why not place a credit spread? So in this example, like I said, you place a 10 days to expiration. That's what DTE stands for. 50-45 bull put spread for $2. And you can do that at the money or slightly in the money. And with the same reward target of $2,000, you could enter a 10 contract position, which would be $3,000 because it's 10 contracts with $3 of risk left from your $2 brought in. Actually, to explain that, I should probably explain this a little better. So, the difference of that is $5. You are paid 2, so that's your max profit, which would be 2 times 10, which would be $2,000. And then, so since there's $3 left, you have a max loss potential of 3,000. And so your max risk is already set at 2,000, and you'll know if you're there in 10 days. So there's no extended waiting time. In 10 days, you're either there or you're not. And then at your stop level, you can have a stop level of your same $1,000 or even less if you place it at the correct spot. And I have some examples in here to show you exactly how I do that. All right, trading, as I'm sure most of you know, is a game of probabilities and math. Really, it's a game of numbers. To really be successful in trading and really have your account grow, you need a minimum of a 2 to 1 reward to risk to compensate for your losses. And I know there's some people that you could risk 50 and you win one, you have a 98% win rate. But yeah, that one time you have one loss is going to wipe out everything you have won. So you want a good risk reward. And when you have a 2 to 1 risk reward, like it says on this graph, is, I'll move that out of the way. So at 2 to 1, you only need to be correct 33% of the time. So that means you could have a 69%, sorry, not 69, but a 67% losing rate and still be profitable. And what if I could show you how to increase that probability of reaching that 2 to 1 risk reward goal? Would you be interested? I think everyone would be interested on how to do that. And this right here is just a quote that John Carter said at one of his classes I was in, and it really stuck out with me as far as how probabilities go. And he said just as it says right there, if you were a blackjack player, a professional blackjack player, and you knew you had a 75% chance of winning, you would play all night long. So to me, what that means is like if once you have your edge, which is where you have a greater probability of success, then you would go keep trading until you no longer have that edge. So that was just something that stuck out with me and I wanted to share with you guys and gals. All right, so first, if you're unaware what this is, I want to do a brief overview of what a squeeze is. If you already know what a squeeze is, just give me about 2 minutes every time. It'd be quick. So a squeeze is a compression in price, or of price. Is it defined by a 2 standard deviation Bollinger Band compressing inside a 1.5 Keltner channel? So what that means is a 2 standard deviation Bollinger Band and a Keltner channel, 1.5 Keltner channel is 1.5 ATR of a stock. An ATR is average true range. So every stock within a certain time frame moves an average amount. So in this example, it is saying that the standard deviation is so compressed, it is within 1.5 movement. So think of it as a spring. The spring is, the tighter you squeeze a spring together, it's eventually going to be released and spring out, right? It's going to explode. That's exactly what a squeeze is. And I have examples of that in here as well. And squeeze usually results in a greater than expected move. And then so an expected move, every option has and time frame or expiration has an expected move. And that's how the options are priced. A squeeze can give you a greater than expected move, which means a better profit. All right, so here's an example of this red line right here. This is the Bollinger Band. And I pulled this picture straight from the Squeeze Pro class. So like I said, the red line right here is the Bollinger Band. This blue line is the Keltner channel. So that's a 1.5 ATR move. So the stock, what you're looking for is this time frame. Whenever the red line gets inside the blue line, price is compressing. And you see once the Bollinger Band starts to go back over the ATR, you have an explosion of price. And then it does it again right here. Once you get above it, you get an explosion of price. Same thing again right here. It was inside, an explosion of price. So that is what a squeeze. And then also they add momentum inside it. So if the Bollinger Bands is inside the Keltner channel and the momentum is above 0, you could look for a high probability move to the upside and vice versa for a short. All right, and this down here is the free squeeze indicator. This is just a regular squeeze. I'm about to show what the Squeeze Pro is. This one down here you can get for free on most trading platforms. And what it basically does is it shows all the mid compression squeezes. And I'll explain that in a moment. So what you're doing is you're looking for dots. In this one particularly, you want the red dots. That means a squeeze. So red dots, squeeze. Red dots, squeeze. Red dots, and again, squeeze. So, and whenever you see that first momentum pick up the blue right there where that is circled, then you see the momentum kick off higher. That's what happens up here, and then it goes up higher. Gets low, compresses above 0, shoots up higher. And same thing. And repeats. So that is a squeeze. All right, now the Squeeze Pro, with the difference with the Squeeze Pro is it gives you 3 different types of squeezes. There is a low compression squeeze, which is identified by these black dots. a mid compression squeeze, which is identified by these red dots, and then a high compression squeeze, which is identified by these yellow, orangish, gold color. So those are the different levels of squeezes. Now the entire Squeeze Pro indicator is this one. So you don't need all this. That just shows you all of them put together. So what it means, what it does is so you got your black dots right there, correct? That's a low compression squeeze. So your low compression squeeze could turn into a mid compression squeeze, which could turn into a high compression squeeze, which usually results into a bigger move. But once you have a high compression squeeze, the only place you can go is to a mid and then into a medium. So you can go black, red, gold, and then red, black, green. Once it's green, that means the squeeze is fired. So green means go. That means the move is happening. Now, it can go just like it does right here, a red to green. So you have your low compression squeeze and fire. It can do that. And then if it goes from red, it usually goes from red to black. Like you can't really tell right there, but it goes from red to black. So your low compression squeeze could turn into your mid compression squeeze, and then your mid compression squeeze could turn into high, and then vice versa. Think of it as like an accordion going in and out. And then, but one thing to note is, say your high compression squeeze turns into a red, so your high turned into a mid. That means your high compression squeeze is fired. And then once your mid compression squeeze turns into a low compression squeeze, that means your mid compression squeeze is fired. And then it just kind of bounces on down and fires out. So hopefully that makes sense. And this is the difference in types of squeezes. So what the difference between low, medium, and high is. So see, kind of go up here. And then here's this one. So it's all based off of the width of the Bollinger Band, which is this blue line. So that one is a low, and you see it gets a little tighter, which is a medium, and then really tight is a high. That is all that means. And the different color bars, those are early in and out signals. So you see the green dots on those candles. That's early in. It's telling you that the move is about to happen. So we have a low compression squeeze right here. Momentum is below 0, which means it's going down. And you get those dots. That means the move is about to happen. If you want to get in the trade, you better hurry up and get in. And look what happened. It fired. And then it fires lower. So that's early in signal. And early out is when the candles change color before the end of the move. So like right here in this example, early in, for the squeeze that was right here, it fires. You see how these are yellow while this is still red? These are the early out signals because it's changing before this does. And it's telling you momentum is about to stop, which it did. See it bounced a little bit. So that is the squeezes. And this is straight up my trading plan that I have typed up. So my rules for my trade. We'll focus on the long setup. So typically I like the 7 to 10 days-ish at the money and the money credit spreads. And I filter them by finding the strongest stock in the strongest sector. My weekly, daily, and 4-hour charts need to be in alignment. And is there a squeeze? And I'll explain what the weekly and daily alignment is. Is there a squeeze? Is the 8 EMA above the 34 EMA? And are the 21 and 34 EMA stacked positive? Is the histogram, which is that blue that was at the bottom of the squeeze, is it positive or starting to turn positive? I must be able to obtain a 2-to-1 risk reward at my stop level. And my entry, so this is my setup, what I'm looking for. Now my trigger, for my entry, I have to enter near the 21 EMA. I have two different types of stop losses. If the squeeze starts to fire negative, the 21 or 34 EMA start to cross over negative, then I get out. Or I close below the 34 EMA, I will get out as well. I also have a time stop loss. So usually I'll enter on we'll say a Monday, Tuesday, or Wednesday, and then the following week is my expiration week. So I'm entering them a week ahead. And if by Wednesday of the following week, or the Wednesday expiration week, if the squeeze has not fired, due to how quickly the position could turn into a larger than expected loss, I'll go ahead and close the position for whatever is available, either small loss, small winner, just cut the risk, the squeeze isn't firing, and then I'll go ahead and find another setup. But my target is 80% of the credit received. And then it is just vice versa for the short side. And I also have, like it says right here, this helps keep me centered, I guess, while trading. Like once I'm in a trade, my only job is to manage my risk. Once I'm in, all I got to do is watch for these things that happen to get out. And that's it. Everything else is in the stock market god's hands. Okay, so we'll go ahead and go over an example. So here's Disney. I have my weekly chart right here, my daily, my 4 hour, and then here is my multi squeeze tool. What that does is the top row is, whoa. All right, the top row is all that's the squeezes, the different levels. So you have red, which is the mid, black is low. If it's green, that means it's fired. And it's all the time frame. So you have the 3-day, 2-day, 1-day, 4 hour, 2 hour, 1 hour, 30 minute, 20 minute, 50 minute, 10, and so on and so forth. You can see what it says. And then the bottom row is the histogram. So it's showing what color this is right there on all the time frames. So what I like to do if I'm looking at a daily, so I got my daily chart right here, right? So I'm looking and I'll be, all right, so this is what the week looks like. What's my 4 hour look like? I can see multiple time frames to see what's happening in all the other time frames to see if we're in alignment. And you can look over here on the weekly chart, you have the early end signals bouncing off all those moving averages. And you have all these larger time frame squeezes. So maybe what may happen is this 30 minute and 1 hour is going to fire, then the 4 hour and daily and 3 hours. So this may move quite a bit higher. Who knows? Maybe it just needs a decent earnings report to get it fired. But, okay, so the setup. The EMAs are stacked positive. The 8 is above the 34. And the 20... Okay, so actually I should identify this real quick. The 8 EMA is the yellow, 21 is the white, 34 is the pink, 55 is the blue, and 80 is the red, I think. I don't really... it's there, but I don't pay overly too much attention to it. All I care are they stacked positive. So they are starting to turn around. There is a squeeze. Momentum is starting to shift higher. We're near the 21 EMA. The 8 EMA is above the 34, and the 21 is starting to cross above it. I know it's not the cleanest setup, but it's what we got right now with the current market conditions. And we also have an early end signal, which is that dot inside the candle. So how would I trade this? So I want entry near the 21 EMA, which is about, we'll say, at 26. So this level right here would be my stop level. That's where I would stop out if price closed below it. So how do I construct it to get this 2-to-1 versus what I was talking about? So we'll say roughly 26 is the stop level. You go to Analyze tab. So we got 12 days to expiration on this one. It's a little bit longer than ideal, but it would work. So if it was about 20, so we'll try the 26, 24 for $2 and get $2 wide, you get 80 cents. So then from there, and for the sake of that example that we did in the PowerPoint, which was we for 3%, so we'll say we have that $100,000 account, so we want a max risk of 3,000. So we could try 20 contracts. If you don't know how this works, you can look down here, and as I move the mouse, you see I have a max loss of on November 7th, the max loss of 2,400. And then the magenta line that's going up and down, that is for the current day. So 2,400, we could add a few more in there. All right, 3,000. And where did we say our stop was at? About 26 or 126. So this is saying, so what you do is you move the mouse over. I'll cover this part real quick too. So this is the price of the stock. That's what that is on the risk graph. Right here is your risk to reward for the position that you have labeled out down here. So this is your typical graph. Profit and loss on the left, price of stock on the bottom for the position that you're messing with at the bottom of the screen. So 126 is your stop. So you move the price down to 126-ish. So we have a max loss, or sorry, not a max loss, but at our stop loss level, that'd be about $565-ish, basically $566, for a max profit of what it says down there at the bottom left, where it says November. I want you to look right there whenever I click off this little eyeball thing over here. It says 2,000. So you're risking basically $566 to potentially make $2,000. Now, and then another good thing is, so right now it's 566 or whatever it was, right? And this, as the days go by due to theta decay, this gets higher and higher up until the option expires. So say a few days go by, it goes up and down, and then it hits your stop loss right here. Your loss may be very, very small, or you may even break even, because this white line on the magenta, that is your break even point. And as the days go by, it moves further back for your break even. So you could have a smaller loss, maybe in a break even. But since you sold the 126, all you need the stock to do is to stay above 126 for those 12 days. If the squeeze fires, then price should move up quickly and you can get out of the trade quickly. This is a theta positive trade. Instead of putting $10,000 into just buying calls and seeing hundreds of dollars decay away in theta, this is how I personally like to put thousands of dollars to work and have time working for me instead of against me. I prefer it that way. That's just me. I have a hard time putting several $1,000s into a trade when I'm automatically already doomed for having a loss because it's the theta is going against me. Sure, you have theoretically unlimited profit on just long calls, but realistically, how likely is that to happen? That's just me, my own trading personality. It's what I like to do. So this is how I trade it. So that is an example on how I use credit spreads trading the squeeze. Now, I was also going to show you this with a good example of using the multi-squeeze. So when you have more than one squeeze, it kind of daisy chains them. So in the video right here looks great. So what I like to see for a big move, this is when I would do like at my longer term trades, I'll do a debit spread to get a bigger bang for my buck. So you see, ooh. Not gonna let me draw in there. I guess okay now. All right. So all the momentum is blue. So that means it's getting ready to fire it. So we have a squeeze on the 2 hour, 1 hour, 30 minute, 20 minute, 15 and 10, and then the 3 day, 2 day, and daily. So what this typically happens with all, like on the weekly chart, we have the moving averages stacked positive, the daily stacked positive, the 4 hour, the 8 you may really dip down, no big deal. So the daisy chain, so what this indicator is good for is the 10-minute will fire, and then the 15-minute will fire, and then the 20-minute will fire, and then the 30-minute, and the 1 hour, and 2 hour, and so on and so forth. You get the point. So when all of them are firing, then you get a much bigger move. The typical time frame for a squeeze for it to fire is 8 to 10 bars. So the 10-minute is anywhere from 80 minutes to 100 minutes, and so on and so forth. The hourly is anywhere from 8 hours to 10 hours. The daily's 8 days to 10 days. So you can see how powerful that could be as it shoots it higher. That is why how I use this indicator right here, and it's very helpful, especially when you look, you just pull it up and look and be like, okay, on larger time frames, I'm bullish. The lower ones are starting to catch up. Where moving averages at. All right, we got some squeezes. All right, and it kind of helps you really plan out your trade without really overthinking it. And now I was going to show you spot is a really good example of using the early in bars, or the early in and early out. So once again, down here, lots of bullishness, right? Because all the squeezes that were right here have fired. All that's left is the 2 day and 3 day. So after its decline, right? So you had early out because they are yellow, as it is still red right here. It's warning people to get out, and yep, it bounced up. So it's accumulating again, and then, all right, we got a squeeze. Squeeze was forming. It's not the cleanest, but the price is above the moving averages, right? The price is above, and then you got your early in signal right there. So it gave you 2 days. So you have 1 dot, 2 dot. You have 2 days above the moving averages saying, hey, it's about to fire. And that signal is produced whenever the Bollinger Bands start to flare out towards the Keltner channel, start to peek out of them again. So it's telling you it's about to move. So once that happens, you see what happens? It just shot up, hit the 618 level, came back down, retested the moving averages, and then just took off again. And it's above the 786 level. So anyways, I really enjoy doing that. You could even do it on just on an hourly time frame if you want to be like a day trader or just an overnight swing trader. So you have your early ins, and then boom. I'll show you an example of the day trading side of it. So that's just a really good example of how to use the early ins. So you had your entry, like, all right, it has a squeeze, momentum's going higher. I guess I had to draw it real quick. So you have an early in, squeeze, momentum's going higher, you're above the moving averages. You can buy, call, debit spread, whatever you want to do, and then ride the momentum higher. Something else you can do if you want to be like a day trader. So So I have it on 1 hour squeezes with early in. So then you could trade 1 hour squeezes. So you're having early in signals. So this one particularly, you're above the moving averages. You have a squeeze going up. You just have a bullish momentum, and you have early in. So you can look for a greater than expected move higher. And you can go here to see what this one looks like. Same thing. This one looks great. It just, if you, it almost looks like a 1 hour little flag. And so what you want is this squeeze down here to fire, and then when it breaks that flag, so it's in a consolidation, right? 1 hour consolidation, got a squeeze. When it's going higher, getting early in signal, maybe a pop up to 39. And so on and so forth. So you just see, like Microsoft has one. See what Microsoft is doing. Okay, so it's not the cleanest. It could be coming up around, and that's when you would have to consider other time frames to see if it's worth getting into. But you're getting your early in signals on the 1 hour time frame. All right, and that's it. That's really how simple the setup is. You really don't need to know much about trading. That's how I get my 2-to-1 risk reward trades. Sometimes they're much bigger, but that's how I trade the credit spreads to hit my weekly goals. Now, down in the description box below, I want to add some links. Simpler Trading was awesome enough to allow me to provide y'all discounts for the Squeeze Pro, the Multi-Squeeze Pro histogram, which was the one where it shows the multiple time frame squeezes in the histogram, the 10x bars, which is the green, yellow, and red one. I'm going to make a video on those and how I use that next, and also the weekly wires. I typically use my 10x bars and weekly wires together for iron condors, and then I use the 10x bars with the squeeze, determining how aggressive I'm going to get with my trade. But yeah, I'll put those in the description box below if you want to check them out, so you can learn from the actual guy that created the indicator, and it changed my trading substantially. I wish I would have discovered it sooner, but I didn't. But oh well, that's life. And if you have any questions, please write them in the comment section below. If you found this helpful, go ahead and like the video, subscribe, share with your friends and family. But yeah, that's it. Let me know what you think. Thank you very much, and take care.